This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 20th. Some highlights from today's show. Japanese 20-year auction fails horribly. The US beautiful bull is to test investors' appetite. And the S&P 500 is aggressively overbought. Good day traders and welcome to the Daily Market Rundown. Let's start and talk a little bit about some of what's going on in the European session. It's another positive day across the board for Europe. We of course sold off initially at the open, but we've since rebounded and we're now up around 0.5% with the likes of DAX, CAC on. So it's just more of that positive upbeat type trading. Now, when we look at what some of the US indices have done, we can see, of course, the S&P is down 0.2%. So we continue to see this sort of divergence out of the US into Europe. And this is a follow-on from what we had yesterday. So yesterday was very much a session of, long Europe, short the US, and at the same time, of course, long German bonds versus short US bonds, as well as long the euro versus short the dollar. So that seems to be the theme that was established, of course, after Liberation Day as a sort of punishment against the US. It was a sort of, we're losing faith in the US, therefore we're going to sell the US bonds, equity indices, and the dollar against all other equity indices, bonds, and currencies. So that is a theme that I expect is going to remain over the long term. Okay, I think this is something that we have to get quite used to. I was actually reading this morning that one of the best performing stock markets right now in the world is actually the Polish stock market. It's up year to date around 30%. So again, it's very much just diversification. I think that is going to be the key, investing theme over the course of the next couple of years. So it's very, very important just to understand that. Now, let's turn our attention, of course, to probably the most important topic we've read about in a while, and it's very much about the Japanese auction that pretty much failed. Okay, I think that's the way to look at it. Now, it's highly unusual because typically we never really focused on Japanese bond auctions for the simple reason that the BOJ pretty much owns the entire bond market. Of course, they have been tapering their purchases, and as a result now we've seen the biggest owner and the biggest buyer step out of the way, and all of a sudden the market falls flat on its backside. And I think this is absolutely important because what we're seeing now is the attempt from the BOJ to reduce its, the reliance on the BOJ owning the bond market, and as a result, we see there are no buyers for Japanese bonds. Okay, and I think this was the key this morning. We had a 20-year auction that had effectively a tail of around 117 basis points. So to put that into perspective, that's 1.17% tail. In other words, this is the amount of yield that investors were demanding to simply own longer dated bonds in Japan. Now, of course, this has got a lot to do with the liquidity available. There's, of course, no longer that very, very big buyer called BOJ. And at the same time, of course, there is concerns around Japan as they are now, effectively from a fiscal standpoint going to be spending again beyond their means. So we're seeing sort of some of the natural buyers step out of the way and say, well, hang on a sec, we don't know if we want to be owning this longer dated yields. And I think this matters so much because it's a very good litmus test for what I expect we're going to be hearing about and potentially even seeing in the US. Okay, it's this scenario of spending beyond your means, expecting investors to shoulder the debt at lower yields. Okay, I think that is going to be a theme now, something to watch out for over the course of this year and next year, which is, this sort of reluctance of bond holders to hold bonds that don't give enough yield. Okay, now you can go and read through this. I think it's very, very important to go read through this and understand it. And ultimately, I think we can see it on the charts. If we go and look at the three different, major duration, look at the 10-year. Okay, that one, as of today, it's up around sort of 8-9 basis points. But we can see if we go a little bit further out to that 20-year auction in the middle, we can see that that's up around 14 basis points. And if we go even further out towards the 40-year, where we know it is highly illiquid, we can see that's up 17-18 basis points. So we have seen a very aggressive steepening in the Japanese yield curve, and that's just simply investors saying, well, we don't want to own your longer dated debt because it just simply does not offer sufficiently high enough yield. Okay, and I think this is something so important to watch out for. When I first saw this, I thought instinctively, well, hang on a sec, this should ultimately initially be quite a problem for the currency. Obviously, we know that when the UK with Liz Truss came out and they tried to spend beyond their means, we know they got punished with much higher yields and also a much weaker currency. Of course, that did rebound when they backtracked. We saw the same thing in the US just a couple of weeks ago, where they were effectively wanting to impose these tariffs. They backtracked as a result of higher yields, and now we see what happens when we get a very, very weak take up of a Japanese 20-year auction. We just get substantially higher yields. Okay. Now, I think the important thing to understand is, what are the implications moving forward? What happens from this point forward? Well, first of all, there is now an expectation from the BOJ to perhaps scale back the speed at which it's tapering. So there's a discussion now that the BOJ needs to step in and provide the liquidity. And I think this is just frightening, as it really does showcase how weak ultimately the markets are without the help of central banks. And it's not just the BOJ, it's all central banks generally. But ultimately now we will find out at the next BOJ meeting whether or not they're going to intervene. I think that really does matter, because we've got to be very closely watching that next BOJ meeting. If they're not going to intervene, if they're going to keep going at the speed of tapering that they're expecting, we will of course see those yields continue to surge higher. Now, at some point, this will matter. Okay, at some point it is going to have implications around the world. Japan is not a small country. It is the third largest country in the world, so it's not tiny. And so it will have some spillover effect. Now, we're not sure where that will happen. You can't really look across the board and think, where is it taking place? Because if you look at the topics, for example, it's flat. Okay, now sure, it's underperforming the rest of Asia today, but there's no real sort of, you look at the markets, you go, hey, this is going to be the spillover. The only impact we have seen is actually on just longer dated yields. Okay, so that looks like very much the play. But one market I think we do have to start sort of paying very close attention to is, of course, the Japanese yen. For two reasons. One, of course, if we are going to see those yields drift higher at some point, we are actually going to start to see that benefit the Japanese yen. Why? Well, because if you go back to last year, you remember we had that little bit of a blow up of the carry trade. That was, of course, as a result of a strong Japanese yen. What it effectively meant was large insurance companies were no longer safe holding US treasuries without hedging those positions. Now, because of what we've seen over the course of the last couple of months, where we're seeing that weakening dollar, I do expect we're going to see some more flows start to be repatriated away from owning US treasuries and into, of course, Japanese bonds. Why? Well, because longer dated bonds are going to start offering some really, really good yield. Okay, in other words, it makes no sense to be invested in the US anymore when your own 20-year bond market is offering you 3.5% odd. Okay, so I think that's definitely something to keep an eye on. And what we should see, if we start to see those repatriation flows, what you will see is a very, very strong yen. Okay, so that's the thing to watch out for. As these yields start to get elevated in Japan, what we should see is that yen start to pick up a little bit of speed. And from a technical standpoint, obviously I'm talking fundamentals now, but from a technical standpoint, I think you all know fine well what this pattern represents. It's very much a very decent head and shoulders. Okay, we've got a very, very key little resistance area. You can see the market's been reluctant once, twice, three times over the course of the last 2 and a bit years. Of course, right now we can see that the yen is quite overbought, but I wouldn't be surprised if over the course of the next couple of days, weeks and months, we do eventually see a lot more repatriation of investors, and particularly life insurers, investing back into Japanese bonds. Okay, now our next topic of discussion is a combination, of course, of inflation as well as the big beautiful bill from the US. And I think this is something to pay very close attention to. This was something I posted in the Discord channel this morning, and it's from Trueflation. Most of you probably follow them on Twitter. Now, they are getting more traction. I would say that more and more people are paying attention to their data scraping effectively. They are doing a good job of actually working out what real inflation looks like. And they're posting this idea that we are going to see, or at least we have seen over the course of the last 18 days, a 0.64% inflation. Okay, now that alone might not mean something to you, but when we annualize that, in other words, we try and work out, well, what is the annual rate of inflation, assuming that's sort of a linear path forward for inflation, it comes out to around 13%. Okay, now blink a few times, because yes, I wrote there 13%. In other words, what they're saying is, if we keep going at this current rate of inflation, we will effectively have a year-over-year inflation of 13%. Now, even if it was half of that, let's say it was 6.5%, or even if it was 4%, okay, if we're going to have year-over-year of inflation of 4%. Well, the Fed has a very big communication problem right now. Okay. Moreover, it's not just the Fed that has a big problem. It's bond holders that are ultimately going to force the hand of the Fed. Okay, because the reality is if you're going to have 4% inflation, well then 10-year yields have to be a lot higher than where they currently are. Okay, 10-year yields around 440 are only offering you 40 basis points of real yield. Okay, now if we do the general rule of thumb, which is GDP plus inflation, ultimately we think yields plus a risk premium, yields should be well in excess of 5%. Okay, and I think that's the key takeaway is if we are going to see inflation heat up, if we are going to see year-over-year inflation of 4%, well then 10-year has got to be a lot higher than 5%. Okay, right now it's obviously trading 445, but what that does mean is long bonds in the US are now potentially going to become very sensitive as we of course lead into the PCE number then this month, and then of course the fresh inflation print that we get midway through June. Now, alongside that, okay, is this idea of the big beautiful bill that's being passed, and there's two things to take away, and I mentioned a little bit of this yesterday, but I think there's some really interesting things to think about. When the White House press official was talking yesterday, she talks of this idea that it's not going to add to the deficit in the long run. Okay, now it's important to understand what she's saying. What she's saying is in the near term, sure, we are going to spend beyond our means, but because all the spending we're going to do is going to create this magic growth and we're going to get so much more tax revenue, in the long run it'll actually reduce the deficit. Okay, that's the general thinking. Now, that's very laughable, and unfortunately I don't think investors believe a word of it because they've seen the last 2 years of Biden spending lead to anything but saving. Okay, so I think this is the key takeaway, is that the market ultimately is going to test the bond market at some point. Okay, the thinking from ultimately the budget watchdogs and banks is that the next 2 years we're going to see 6 to 7% deficit as a percentage of GDP from the US. Okay, this is very much exactly what we've had in the last 2 years. So we're having 4 years of 6 to 7% deficit spending. Okay, now at some point the bond market is going to lose patience. At some point we are going to see the spiral, and I suspect that's coming this year. If this big beautiful bill does pass, I do expect we are going to see those 10-year yields well north of 5%. And like I said, when you couple that with the idea of inflation not just above 3%, but perhaps much higher, it really does point to a nosebleed type situation coming at some point. Okay, now with that in mind, of course, if we couple the Trueflation report, we couple this big beautiful bill, we couple with what's going on in Japan, and we fast forward and have a think about what's coming tomorrow. Well, we've got a bond auction from the United States tomorrow, a 20-year bond auction. Now, it may be strong again. We obviously know that the last 2 months of longer duration bond auctions were absolutely solid. Not even an inkling of weakness in either of them. The point is that at some point we are going to see that weakness. Okay, at some point that is ultimately going to create fear. That fear will then lead to much higher yields. Okay, that being said, here and now, it's all good and well talking about fundamentals and being aware of what could be, should be, but that's kind of pointless as day traders. As day traders, what do we want to pay attention to? Well, look, the Fangs, I think, sent a good signal yesterday. If you were trading the session, it was very much a sell-off overnight and then call it a stop run or a short liquidation move in the afternoon session. That's all it was, okay? The price action suggested, what does a stop liquidation move look like? Well, we effectively sold off, and then when the cash opened, it did a straight line reversal and did nothing for the rest of the session, okay? And that suggests to us that it was just very much a liquidation move yesterday. Now, there is talk and chatter that it was the retail market again buying the dip, as they do, but there was a small little observation to make yesterday, and I think this is going to be key to today's session. The Fang Index, the thing that actually drove us up to where we are, was quite weak yesterday. Okay, and I'll show you the Fang chart in a minute, but if we look at the general major stocks of the S&P and NASDAQ, you can see they're all pretty much flat or down. Okay, and I think that's a key takeaway, because what it suggests was there was no real interest to be buying the Mag 7 yesterday, and yet the indices ultimately went bid. Okay, and that just confirms that yesterday was a short squeeze. It was effectively those last bit of sellers getting squeezed out on the Moody's news, and so I suspect today we are going to see a retracement of that move. I think we'll start to fill out that move. I don't think we're going to have any kind of fireworks to the downside, but I do suspect long-sided trades are going to be at risk today. Okay. Now, with that in mind, there is the Fang Index. You can see we actually did post a down day yesterday. Okay, didn't look like it, of course, on some of the indices like the Nasdaq and the S&P. They both closed quite strong, but we can see, of course, the Fangs did already begin to offer yesterday. Okay, with that in mind as well, we can see the Fang Index is well above that 200 moving average. We're very close to those record highs again, and so I do expect just a little bit of consolidation. Now, confirming that sentiment, if we look at the S&P 500, the moving averages chart, there's a few little things to pay attention to and a few sort of scenarios of what to expect and how this can all play out. Firstly, the camp that I'm very much in is very similar to what Jamie Dimon said yesterday, which is this idea of, the markets are really kind of discounting all the risks. Okay, the tariff situation is not gone. It very much is not gone. There's a number of other very, very big risks on the horizon, including, like I said to you yesterday, 30-year bond yields sitting at 5% is a problem. It's a problem that will eventually hit the SPY, but right now it's being shrugged off, and by and large it's being shrugged off by the retail market. Okay. Now, sure, the retail market could be right, and sure, the price action is strong, and we don't want to fight the price action, but we do also have to understand the context of the market. Okay. Right now we are extremely overbought. Okay, we can see it on the current price versus all the moving averages. Now, there's three ways the moving averages play out from this point forward, and there's three sort of examples we can lean on. Okay, currently, if we look at the price action that we're seeing in this year, in this sort of move over here, it's very, very similar to what we got in this small little 10% correction in the middle of next year when we had that growth slowdown concern. Okay, where we had, of course, quite an aggressive sell-off. Once we found that low point, we then got the straight line bid back up towards those record highs. Okay. Now, what I want to point your attention to is ultimately how the 20-day moving average yielded support to sustain the trend. Okay, this is going to be key to, if you long this market, ultimately what's going to be very, very important is that at some point this 200-day or this current price is going to have to retest that 200-day moving average. Okay, now I can do it in one of two ways. It can sell off and retest it, or it can consolidate and sit for a couple of days and weeks, let that 20-day moving average catch up, and then fine. We grind our way into record highs, VIX squashes back down to 16, and we're off to the races. Okay, that is very, very much one plausible scenario, and a very, very likely scenario. It's probably the most likely given the pattern is repeating itself. Okay, so we've had that key reversal. I expect consolidation and perhaps continuation. However, there's another potential play that you've got to keep a close eye on, and that's when we look at the 20-day versus 50-day moving average. Okay, now ultimately, again, how you look at these moving averages, it's all just contextual. Okay, there's no hard, fast rules. It's very much contextual. But what I want to point your attention to is in the 2022 sell-off. Okay, you'll note that the 20-day moving average had a very aggressive sell-off. Okay, we can see it there. And ultimately, we came back and we tested in and around the 50-day moving average. So if I just point out this little test here, so we could see the market sold off initially. We had the first pullback, and we could see that 20-day moving average in blue. I'm just going to remove some of these highlights. Okay, the 20-day moving average in blue came back, and it retested the 50-day to the tick. Okay, so right about over there. But it failed to get back up above that 50-day moving average. Now, the reason we use 20-day and 50-day and compare the two is because it's effectively looking at monthly versus quarterly price change. Okay, so we can see that the monthly price change could not reestablish itself above the quarterly trend. Okay, and that's why we ultimately then roll back over. Now, it's a very, very similar scenario here where the 20-day has gotten above, of course, the 100-day, but it's not yet gotten back above that 50-day. Okay, so long as we're below that 50-day, there is very much a chance that we are going to have a repeat of 2022, and effectively this is just one very, very aggressive dead cat bounce. Okay, but I appreciate now that the dead cat bounce theme or idea is very much perhaps dead already, but keep a close eye on that 20-day moving average. If we get back above that 50-day moving average, like I said, all bets are off. We are going to not just get back up to that record high. We're going to then start to stage a very, very grindy type move up into record territory. Okay, so that is the base case right now. It's very much just watching closely how the market responds at these prices. But like I said, very overbought territory. So very much likely we are going to get a lot more two-way trade over the course of the next couple of trading sessions. Okay. And then finally, just to update on those yields, we can see that 30-year yield back down at 493. We did get about up to 503 yesterday. So we are about 10 basis points lower. But like I said, it's all about what that moving average does. Okay, do we get above that 477? The longer we hold above there, the more that tightening has implications for the economy. Okay, it's not always about the absolute price. It's very much about, you know, what the average price is doing over a longer term horizon. Okay, and then of course we can see that SPY continues to roll back up towards those record high territory. All right, with that in mind, of course, there is no real key economic data today. We've got that 20-year auction out tomorrow, which will be very, very closely watched. So it is going to be another perhaps slow session. Like I said yesterday, the VIX was not pointing towards being aggressively short. We did get a little bit of hedging, but the structure looks effectively like it's going to be a repeat of yesterday's session, where it's going to be kind of slow, kind of grindy. Markets perhaps waiting for some type of catalyst to move one way or the other. With that in mind, if there are any other questions, do post them in the Discord channel. Otherwise, good luck out there. Manage that risk. Go make some money.